Welcome to Bloomberg ETF IQ. I'm Katie Greifeld.
And I'm Matt Miller. Happy to have you back. You were gone for like a month.
It was just 1 week, but it felt like a month.
Felt like a long time. Let's get to the biggest stories right now in the more than $10 trillion global ETF industry. Countdown to the Fed. The central bank widely expected to keep rates on hold, but we saw the 10-year today hit 435, the highest level since 2007.
And the question, of course, is how high for how long? We're going to talk about that, plus the unloved rally. We're going to talk about that outperformance that we've seen both in high yield and leverage loans with John Kerschner from Janus Henderson.
It is also Climate Week. We'll discuss the drop in the popularity of ESG funds as protesters call on world leaders to end the use of fossil fuels.
And Matt, before we get there, as always, Eric Balchunas from Bloomberg Intelligence here with us now, taking a look at the flows. Eric, what do you got?
Katie, Matt, thank you. Katie, you called the unloved rally. I think that's a good phrase. It shows up in the flows here. I was going with ambivalence, but I think unloved works just the same. Now, this isn't to say there isn't flows going into equities. Look at the top of the list, IVV, VTI, the Qs, right? That's good. That's retail and trading crowd both getting into the market. And of the $22 billion into ETFs in the past week, only $2 billion of that went to Treasury ETFs, the rest into equities. So again, good. Let's look at the outflows though, and I'm going to hit you with some bad news. So look at the outflows. You're going to see SPY, IWM, VOO, so almost a reciprocal of what we saw going in. So this is a tug of war going on. So I can't say it's entirely bullish, but again, if you look in total, more money going to equities than out. And I said $2 billion's gone to Treasury ETFs. You think, oh, well, that's good. It isn't really, though. The problem is there's something that's not in ETFs that is kind of bearish in a way, and it's a money market mutual funds. We now have to look at this because they now yield 5%, 5.3%. And so when investors feel like they want to take money off the table, they're going here instead of Treasury ETFs for the most part. This line here, you can see they took the summer off, but it's inching up again. In just 1 week, I know that looks like not much, that's $18 billion, right? That's a lot of money. That's because they have $5.6 trillion. So money coming into money market mutual funds is sort of like, hey, I want to be in equities, but I also want to hedge my bets being in the money market mutual fund and collect that 5.2% yield while I'm at it. So we're sort of seeing what we saw in the spring coming back in the fall.
It's pretty good. And Tom Keene is in triple leverage cash, which is maybe better than just MMFA index. All right, joining our conversation is Amanda Rebello. She is head of Xtrackers sales for U.S. onshore at DWS Group. And I'm going to go ahead and suggest that you change that. Because I don't get what you do from that, but...
We can ask my boss for a promotion and I just take all of US.
You're basically
perhaps.
running the ETFs here in the U.S., right?
The sales team, yeah.
Okay, so what do you think about this flood into money markets that Eric just showed us? I mean, cash is still king. Is that what you're seeing as well?
Yeah, so we do see a lot of clients still sitting on a lot of cash, and either they've gone into cash outright or they try to think about cash plus. We're speaking with our clients a lot about thinking you have to allocate to equities in some capacity, right? S&P is yielding about 1.55%, but you're against this almost 5% level on the cash side. So we're speaking a lot about European equities and in particular dividend strategies. So we're looking at HDEF, which is our high dividend EFA exposure, and that's yielding about 5.5%. So at least offering some value from that income perspective and also a low volatility versus S&P 500.
So dividend products, I would imagine, are not too hard of a sell, but what do you say about European equities, especially when you're talking to a U.S. audience, which already has a home bias, and then you look at the outperformance of American equities? What's the pitch?
So the pitch is very much one of diversification. So I think a lot of us are feeling that US equities are quite toppy. So S&P today is at around, I think, 4450 or so, something like that. Our end of year projection is actually 4100. So we think there will be a downturn. And then even when we think about longer term, we think it's only going to rebound to around this level in a year's time. So European equities, on the flip side, we see a lot of value there. Yes, we're a European house, but we do feel, along with a lot of our competitors, that there is some component for upside on European equities. So we like it from that perspective. Much lower volatility as well. European equities don't have the brunt of the tech names like we have on the US side. And then again, this div story as well is really making sense. It's bird in hand theory ultimately.
And what about high yield? You guys introduced HYLB a couple of years back. You kind of undercut the high yield category, got a couple billion, and then BlackRock came in and tied you. And now State Street's come in at 5 basis points, right? And immediately seen flows. So I guess just get your take on whether high yield, because it's been a little unloved despite the higher yields.
Yeah.
And what about the fee war?
It is still relatively unloved. We do see a lot of clients still wanting to take, well, if they're not going to be in cash, then they're going to be on the IG side, and even within IG, kind of higher quality. But high yield, we think there's still an opportunity there. When we look at versus historical levels, the risk-return profile, it's looking quite good, actually. And what we think makes sense is to then think about segmenting within high yield. So looking at a low beta version of high yield, for example, like HYDW. That's basically looking at the higher quality names, the higher yielding names, the lower yielding names within high yield. So it's kind of a nice like in-between product. And that's where we think the interest should be going forward.
What about ESG? Speaking of unloved, right? I mean, certainly on this side of the Atlantic, that's not a phrase that people want to even use anymore.
Yeah, and it's interesting. It's Climate Week as well this week. What we see is there's actually a lot more distinction on the ESG side. So 4 years back, we were seeing broad-based ESG, but now we see, in terms of the flows and then also in terms of the products which are coming out, more climate-focused. So we came out with our USCA product in April, largest launch in history, 2.04 billion. We see also a lot of clients thinking more about, okay, where can they put their money to work and what's actually having a bigger impact. And so we've actually put a paper out recently from our CIO office, which is linked to helping clients to think about which benchmarks to choose. So I think a lot of us understand that ESG more broad-based, the impact component is relatively little. But if you think about either climate transition, so companies that maybe haven't started yet to minimize their emissions, but are looking to do so. They might be SBTI signatories, for example.
Right.
They might already be on the trajectory. This is making more sense than just outright thinking about removing fossil fuel emitters.
Well, that's what I'm really interested in. When you think about broad-based ESG, obviously the ESG umbrella has become politicized, weaponized, if you will. Is the solution then to just get specific, to narrow in that I'm talking about the climate here, or I'm talking about governance and how companies are run?
I think it's coming back to what are you really aiming to do? So ESG has become a little bit like a thematic or a marketing kind of term.
And you are a certified ESG analyst.
I am, yes,
We're
which means that I've done my
products,
homework, exactly, I think that's the thing. Like, we have a lot of people who are deeming to be ESG specialists, but do they actually have the training? At DWS, pretty much all of our investment platform has done this certified ESG analyst training, and it means then that we're genuinely qualified to be helping investors with that component. It's not just a marketing gimmick.
And look, I agree with you. I think broad-based ESG, it's hard to dislodge Vanguard and cheap beta, but adding it all on top is the way to go. I think you have one that I think is interesting, the green infrastructure.
Yeah.
So then you're giving money to companies that are moving this forward, and that does complement the cheap beta. Infrastructure, interesting, is the third most flow-getting thematic category this year out of about 20.
Yeah.
So talk a little bit about what makes it the difference between green and regular infrastructure ETF.
Yeah, so we're really proud of this product. I think a lot of people paid attention in the US market to the Inflation Reduction Act, and then prior to that in 2021, the IIJA. And so this product is aiming to provide a purer play into that investment, which is going to be taking place. So over the next 5 to 10 years, the US government is actually going to deploy another $370 billion into green infrastructure. So that's things like green mobility, things like electrifying rail, tolls, things like that. Additionally, things like green energy production as well. We think these are really important parts of helping the US economy to actually get back to its rightful place in the broader economy. When we look at the World Economic Forum, they've actually ranked US infrastructure more broadly as a score of 14. It was number 2 in 2002. And so,
so that's bad.
It's bad, but I feel like we want to do justice again to the US economy, and a lot of that hinges on having good infrastructure.
Amanda, great having you on the program. Thank you so much for coming in and joining us. Amanda Rebello, there of DWS Group. Coming up, this year's hottest options trade has found its way into the ETF arena for the first time. We'll tell you what that is next. This is ETF IQ on Bloomberg.
Welcome back to Bloomberg ETF IQ. I'm Katie Greifeld. Time now for the ETF brief, where I walk you through the trends and the stories that caught my eye in the ETF industry. And we start with uranium. Specifically, we're talking about uranium miners here. This is an ETF that tracks those companies, ticker URNM. It's up almost 41% year to date. A lot of that rally coming in the last month or so. And this is interesting because you look at uranium itself, only up about 32% year to date. So obviously those miners outperforming. Let's also talk about high yield, because one of the stories this summer has been State Street coming out and cutting the fee on SPHY, that's their high yield ETF, from 10 basis points to 5 basis points. And they immediately saw a return on that. You can see in August that ETF took in over $600 million. That was a record for this fund. So again, an immediate payoff for State Street there. Let's also talk about zero-day options. We haven't really talked about it on the ETF show. Now we have a reason why. Just to really put this into context, zero DTE, they make up about 40% or so of total volume on the S&P 500. It's the hottest options trade, Matt, and it's finally made its way into the ETF world.
Yeah, 0 days to expiry options. Let's talk more about this issue, Katie. Let's dig into it. Let's get into the weeds.
Why not?
Right now with Bloomberg cross-asset reporter Isabel Lee. This has been an options trade that has taken the market by storm, maybe made the VIX irrelevant. What do we know about zero DTE or what do we not know that we need to?
Okay, quick primer, because you did ask me off air, what is it? So basically there are options that, bet in market direction, but what makes them unique is they have a 24-hour expiry. So it's super short, which makes it super risky, but also cheap, because we know that options are priced on their time value, and that's why it attracted a lot of retail investors, especially during the height of the pandemic when a lot of people had a lot of time. But also in 2022, big exchanges like SIBO extended it from 3 days to 5 days, and so that's why a lot of people like it. So this ETF...
Wait, 3 days to 5 days on 0 days?
Yeah.
Oh, I get it.
Yeah.
Yes.
Yeah.
Kind of a mind. So then this ETF utilizes zero DTE, and it's the first.
And that's kind of amazing that it is the first, given that this is, we've been talking about it for, what, a year now? Usually it takes like 2 weeks for a theme to come into the ETF world. How did Defiance, that issuer, actually put this into this wrapper?
So they're the first, and when it comes to 24 hours, but then they're not the first that utilizes or sells options. We have JEPI, which is JP Morgan's equity premium income.
Yeah.
We know JEPI.
So the difference is JEPI isn't daily, so this is daily, and they also filed for their own JEPI, but with a Y, and it tracks S&P, and they also filed for contracts that track Russell, but they haven't launched yet. Only the Nasdaq has launched. So it's risky. As I checked on Twitter, which, as we know, is the most relevant sentiment check, a lot of people were divided. Some people were like, finally, but some people were also saying, how did the SEC approve this? Because it's very risky.
I mean, I'm in the finally camp, and I can imagine that they're very good at settlement and they can deal with this as long as they do it every day, which they are. Is it going to blow up even further the options trade, the ZDTE options trade?
It will give more access to retail traders, and that's why, I mean, you don't even have to know how this works. You can just buy an ETF, and that's
no
the
one
beauty
knows
of
how it
ETF.
works. Yeah.
We know a little about how it works. I know how it works.
Well, it'll be really fascinating to see how this ETF does. Of course, that's coming from Defiance. Isabel, thank you. That is Bloomberg's Isabel Lee. Now, still ahead, we're going to drill down into CLOs and that unloved rally that we keep talking about today. We're going to do that with John Kerschner of Janus Henderson coming up next. This is ETF IQ on Bloomberg.
This is Bloomberg ETF IQ. I'm Matt Miller. Kate Greifeld is back.
Kate, Katie, whatever you want. Eric Balchunas, though, from Bloomberg Intelligence, he's back with us now for today's drill down, where we focus on one ETF. Eric, what do you got?
Thanks, Kate.
Okay.
We're looking at JAAA, that's what I call it. It's the Janus Henderson AAA CLO ETF. CLO is collateralized loan obligation, which is basically pools of senior secured corporate loans, and they float, right? So in an environment like this, people are looking for that kind of thing. It's actively managed. That's important. Janus is basically picking these for you. And the fee is 22 basis points. That's pretty good. That's really low for an active fund, which is part of the reason it has $3.9 billion. That is a stud hit ETF. It was also first to market. That helps a lot too. But you could see $3 billion or almost $4 billion shows how much interest there is here. Let's look at the holdings. You're probably not going to recognize a lot of these, but again, these are CLOs that Janus is picking for. You can see the weightings there. It's pretty evenly distributed. Now let's look at the return. So there's a BlackRock filing. Since this one was a hit, everybody has launched one now. I put BlackRock's here just as like the competitor, and I also put AGG, which is the total bond ETF, and TLT. You can see both these are easily beating these two, right? So these are having good returns. And look at this. These are the two CLO ETFs. Look at the steady, non-volatile path. That is very desirable. Low volatility and almost no correlation to anything, kind of like gold or GLD. So Katie, look, low fee, actively managed, nice return, low volatility. There's a lot to like here, and that's why it's got $4 billion.
Eric, thank you. And joining us now to talk about this ETF, I'm thrilled to say, is John Kerschner. He is head of U.S. securitized products over at Janus Henderson. And John, Eric walked us through it a little bit, but let's just talk about how big this ETF has gotten, because right now we're staring at almost $4 billion. A year ago, that was about $1.6 billion. So it's really ballooned in size. Where's the interest coming from? Who's buying this fund?
Really, just a broad swath of our clients. Retail investors, institutional investors, pretty much anybody this ETF works for. And the reason why is, like Eric mentioned, it's floating rate and it's non-correlated to a lot of other things out there. So what happened last year, the Fed started raising rates. A lot of fixed income products did not do that well, simply because interest rates went up, so bond prices went down, and a lot of fixed income products were down in double digits. JAAA was actually positive last year, and that has continued this year. So our message to investors is what you want is safety, liquidity, and a diversification benefit, and you're getting all those with JAAA.
I'll ask the dumb money question, which is my role on this show. I remember back in 2009, I was walking on the beach with Eric Schatzker, and we were discussing whether CLOs would come back. You know, that was kind of the dynamite that set off the great financial crisis explosion. Is there any reason that investors should be worried about? I know these are A's, right? But there's an ETF with B's in them too, right? So should we be worried about CLOs?
So I'm going to correct you there, Matt, because what happened during the global financial crisis was a CDO, not a CLO. Now, it's one letter, it's an acronym, I get it.
Debt loan.
Debt loan, but those were made out of, the CDOs were made out of subprime mortgages, mortgages that should have never been issued. And because whenever you create something out of security that is fraught, what happens is when the housing bubble blew up, then all those securities blew up, and then whatever you made out of them blew up as well. So what happens with JAAA, it's made out of leverage loans. Leverage loans have had a very long track record of good performance through good times and bad. So even if we went into another GFC or another COVID, what happened with CLOs is they actually performed quite well during that time, and they're actually safer these days than they were back then.
So I want to ask a little bit about the correlation. I used to think gold was the king of zero correlation, which is kind of a holy grail, right? You're not correlated to anything, which makes it a good hedge or an alternative at least. You guys have better zero correlation to emerging markets, Bitcoin, TLT, which is treasuries, the stock market. How does it have such perfect zero correlation to everything? I've never really seen something that's this zero to everything.
Yeah, I mean, we could talk about this for an hour, but bottom line is what...
We've got 3 minutes.
Yeah, exactly. So we're not going to talk about it for an hour. But bottom line, when the Fed is raising rates, that affects almost every financial asset out there, even gold, right? Because as rates go up, people say, well, I want to be in fixed income, not gold, because you don't get any cash flow over gold. Almost any asset out there will be affected by the Fed. Now, a floating rate asset like JAAA, it doesn't have a headwind from higher rates. It actually has a tailwind because that coupon keeps stepping up.
As long as they can pay.
As well, they can pay because the loans are the loans that make up the CLO are adjusting at the same time. So leverage loans as well, but leverage loans have a lot of credit risk. JAAA is just taking some of those cash flows and taking the safest portion of them, and that's why it's rated AAA.
So we've talked a lot about JAAA. Let's talk about a JAAA, which Matt mentioned, because I thought this was pretty shocking. You take a look at total returns year to date. I mean, we're talking about almost 13%. Then you take a look at the inflows, and they really haven't been there. I mean, 23 million or so year to date. When you think about that compared to what we're seeing in JAAA, which is also sitting on positive returns year to date, why isn't there the same magnitude of appetite for these BBB loans?
I think there will be. A couple of things. The track record is obviously less. We launched it just over a year and a half ago. So people want to see, this is a new product. It's going to have more volatility. How is it going to react in different markets? JAAA is a very simple story because it is so high credit quality. But we are starting to get some small inflows into JAAA. But bottom line, what we said at Janus Henderson is, look, we want to make sure that we have a bit of a track record, that we show off our expertise in this sector, and then once we have that, we will go out there and pound the table. One other point about JAAA is everybody came to us when we launched it and said, when should I get in? When should I get in? What's the good timing? And the bottom line is, there's never a bad time, never a great time. Now, you know, if we go into some kind of downturn, maybe prices will go down, the yields will go up, and that might be a better time. But it's kind of like stocks. When you're trying to time stocks, it's really not a great thing to do because no one ever gets it right. If you want a high quality, high yielding product that's floating rate, JAAA is great. So I would recommend it.
So not much time left, but to your point that investors want to see more of a track record, is that the case when you think about some of these platforms, some of these wirehouses too, that basically this product hasn't been on the market for long enough?
That's exactly right, Katie. And so, look, we want to make sure our investors have a good experience. And so we tell them, we try to outline the risks and the reward, and then have them make their own decisions. But bottom line, JAAA will grow, as well as our new ETF that's coming out in November. Look for that one, and be happy to come back and talk about that in a few months.
Nice
John,
tease.
Yeah, it was great having you here, and especially explaining the difference between CDOs and CLOs. I think you did better than Margot Robbie, so I appreciate it. John Kerschner of Janus Henderson. If you just can't get enough of ETFs, by the way, a reminder, you can listen to Eric and Joel Weber on their podcast, Trillions. It's bi-weekly. It covers the industry. Does that mean every 2 weeks or twice a week?
Every 2 weeks.
Every 2 weeks. That does it for Bloomberg ETF IQ. I'm Matt Miller with Katie Greifeld and Eric Balchunas. This is Bloomberg.